Hello, everybody. Good morning, good afternoon, good evening, depending where you are in this universe. So, first, I want to say it's the purpose of this model is because I wanted to illustrate how a project finance modeling test is done for an infrastructure private equity company or an investment banking focused on infrastructure. Uh, and they typically ask you to do a modeling test, and this is done typically for the analyst and associate position. So what I took the liberty of creating this model to illustrate how it is should be done, and I wanted to create something basic for people to understand because when I was doing these modeling and trying to advance my modeling, I wasn't able to find something very simple online, but rather something that is very complicated with a lot of macros. So without further ado, I'm gonna go through the structure of the model and how it is created, and I'm gonna illustrate how it is very simple and it is not something to complicate matters for you. I'm not going to go through exactly how the calculations are done. I'm going to leave that for you to do, but I'm going to cover how the data is flows through the model and the structure of the model and how uh, and the important aspects to know what they ask you for in the modeling exam. So to first start, um, I'm taking the assumption that this project is in Chile and and that the equity holders will take a project finance loan to finance around 75% of the project. And they will acquire the project in developing stage and construct it further for 2 years, and then it will operate over 25 years. Um, what I included in the questions are just the simple basic question they would include in a project finance model. They would ask you to build a simple financial model that includes all the returns and the maturity of the project. It needs to have an output of the projected financial statements with cash flow statement, income statement, and balance sheet with a graph and accumulated cash flows and IRR of the investment. You should be able to elaborate on the modeling assumptions and simplifications that you have done. And the most important part really is the conclusion and what you conclude the project should look like. Should if it's a what your idea of this feasibility study is, if you think they should invest in the project or not, and what they should negotiate with the bank, and your added comments there. Like make sure you add 10 bullet points so that it covers all the information required. And last but certainly not least, the model needs to look nice. It can't be spread all around without a good design structure. It has to look good, and the presentation also needs to look good because if it doesn't, then um, it's going to confuse the person trying to look at your assessment, and they may just close the file and just say, okay, I'm not gonna interview this person any further. Because trust me, as much as it is hard to create a model, it is hard to look into how another person created the model, because what a model is essentially is a scratch sheet, and it's your scratch sheet, and giving it to somebody else to look at your scratch sheet is just crazy without having it done in a structured way and easy way to be able to optimize. So the project is I took an onshore wind project. They're usually gonna ask you about a solar project or a wind project, and it's going to be simple with the start of acquisition period and the end of operations. I included two power purchase agreements just to complicate it just a little bit further. It's usually just one power purchase agreement. And I included the capacity factor. The reason why is because usually it is like that. They want to see if you understand the idea behind a capacity factor. So what is a capacity factor? It's basically, so here each turbine is capacity 3.8, and you have 99 turbines over here. And this is the capacity factor, but this is not the energy generated. The energy generated is how much the power goes through each hour every year. So you need to multiply this by 365, multiply this again by 24 hours, and multiply this by 34%. So right here in megawatt hours, you have how much energy is generated. I do this calculation later in the investment analysis sheet, and this is where you will find it yourself. It is very easy calculating it, and so moving forward, I included two OPEX, two inflation assumptions. And the first assumption is a revenue assumption, and the second assumption is cost assumption. The reason why I did that is because I want to be able to sensitize both and to have freedom to change it for both, to see how inflation will affect from the cost and from the revenue side the project. Typically is depreciated linearly over time, and I included corporate income tax of 30% and a tax carry forward which is indefinitely. The debt size of the project would basically here what I asked for is that the debt size is basically your capex, your purchase price, and your interest during construction. And so what you will later notice is that my loan, how I calculate how much my loan is, I need to know how much my purchase price is and my capex is, but I also need to know how much my interest during construction is. But to know my interest during construction, I need to know how much the size of the loan is. So you have a sort of a circular reference here, and you will notice it later on which I cover it. To avoid a circular reference, I just do a simple copy paste over here, and usually you have a macro, but I wanted to avoid complicating the model, and I wanted to have something simple because this is what's important, to have something simple when you're doing a modeling test. Just do a copy paste and just move forward. The other assumption is that the DSCR, because this states this not just the size of the loan, but it states the tenor of the loan. So how much the loan extends for, how much the period is. And the lending banks would require you to pay a certain amount every year and not go under that. So you can use that to build your assumption over here. And this is where I later talk about debt sizing of different DSCRs. And so in the next video, I will discuss, or in a few minutes, I'll just take a pause, and in a few minutes I'll show you the operating sheet and how everything is calculated and how I'm not going to go through the calculations, I'm just going through the basic structure of the model. Okay, so onto the operating sheet. So on the operating sheet, this is where I include all the inputs from sheet 1. The reason why I put it in sheet 2 is because I wanted to leave the first sheet where all the instruction manual is as it is. I didn't want to link it to the model. And under the input, all the input information is where I have the operating model. So this is where I do all the calculation of the model, and it is split between the timing, the operating statement and operating cash flow, the cash waterfall, and the supporting schedules, the tax credit, which goes into your balance sheet, and this is the debt sizing. And below the debt sizing, I have a little bit of a data table, and I will show you how I did it. And you can see this would show you basically how much on each requirement of the DSCR your loan will be amortized over time. So the smaller the DSCR, the bigger your loan payment every year in principal amount. So you can see that the smaller it is, the more you amortize your loan earlier. And I included it in red so that it signifies that this is actually a data table. You can see from over here. Under it, I included the levelized cost of energy. And the reason why I included that, I usually do that because I wanted to I want to include something extra for the assessment so that I can show the team I did some extra research. And the reason why I did that is because later on what you will see is that I include a graph which I compare the levelized cost of energy of this plant compared to other technologies. I got that from uh, uh, Lazacht, and I did that. So this signifies that you are able to do further research than what is required. And so under the levelized cost of energy is where I do uh, all the sensitivities. So I do other data tables. So what this data table tells you is, okay, so if my DSCR assumption changes, how would it change my equity IRR? How it would change my project IRR, my refi amount needed by the end of operating period, or if there will be needed a refi. A refi, so basically at the end of the period, would I need to refinance my project loan with another bank to pay back my previous loan? And this is the percent of how much of the loan is being paid down by the end of the operations of this project. And and I include that for the first PPA also. So I do like a sensitivity on the first PPA and a sensitivity on the second PPA. And also the same variables I sensitize, which is equity IRR, project IRR, refi amount, debt deleverage percentage, and whether I need a refi or not, and what is the debt tenor of the loan. Under it, I do break-even analysis, and this break-even analysis tells me how much my first PPA needs to go down by, the second one, and the capacity factor, the O&M cost, how much it would need to increase, the system cost, how much it would need to increase, so that my project would get me a project IRR of 0%. Right here, I sensitized the capacity factor. So as the capacity factor changes, how does it change my IRR from both a levered IRR and an unlevered IRR? I will not go into too much details of how I calculated my operating cash flows, but what's important here is because essentially, to understand project finance, you need to understand that during the construction period of the project, you are essentially paying down interest for the project using the loan itself. So, so to calculate that, you would need to know how much my debt size is. And to know how much my interest is, I need to know how much my debt size is. So you can see there is sort of a circular reference here. And to avoid this circular reference, what you would do is basically you would calculate how much on the first year of construction your expenditures are. Because on the first year of construction, just as the given says, I'm purchasing the project for 40 million. I'm paying for construction 167 million. I'm paying interest 6.5 million and advisory fees of 3 million. And this is the whole total of my uses of fund. Actually, this is a mistake here. This is uses of funds, and this is sources of funds. And how do I calculate the interest and my advisory fee? I do that by knowing how much my bank loan is. So primarily what I need to do is so when I first start, I don't have anything here. and what I include is the acquisition cost, construction cost, and I don't know what my interest is, and I don't know what my advisory fees are. But I do some with the empty cells here, and then I uh, I put my construction loan. And just as the given tells us that my construction loan is 75% of the construction fees, and all the fees during construction, including interest and advisory fees. And so my debt size is, so what I'm drawing down on the loan is 155 million on the first year. So to get how much I'm paying interest, I just simply copy that here in values. And so here, to avoid the circular reference, but you can see that it keeps changing because it uses that to get that, and then it gets that from the other side. So this is, you keep doing it a couple of times until it's equal. Right here you have it. So yeah, so you avoided the circular reference here, and you avoided putting in a macro. So basically just to copy paste, it's very simple. And the debt sizing, how I did the debt sizing is basically I get how much my debt service, my debt, exactly, my debt service is by getting how much my CFADs are, so the cash flow available for debt service, and I divide it by the DSCR, which is 1.8 here. When I get this amount, I know how much I need to pay loan I need to pay for my interest and my principal amount each year. And assuming my opening balance for the loan, first I start with the 0, and at the end of the period, so for the first year, I need to get the debt drawn from the sheet where I calculated how much my bank loan is. And uh, this is where I calculate how much my closing balance is every year, and this is taken from the year before, and I calculate how much my repayment is by subtracting the interest charge every year by the debt service amount. So this would be how much I'll be paying in principal for my amount and how much it would be amortizing each year. Why I included a data table is because it's nice to present it in this form. So what this does is basically I'm getting the data from the red table here, okay, and each color of the chart represents a different DSCR. So what this is telling you is that only for the DSCR of 1.7, the debt will amortize in 2045. So the debt tenor would be around 20 years. And it's nice to represent it this way. It shows an extra effort. Also, for the other part of presenting the information, so what I showed you about Lazard is very important. It shows that, okay, so this is an onshore wind project, and it seems like it is beating a record. You know, the minimum reached per megawatt hour is $38 per megawatt hour, and this plant is assuming that the project will cost around, in levelized cost of energy, around $33 per megawatt hour, which is breaking a record. And it's important to show that because, I mean, it is a breaking record project by itself. Uh, it's nice to represent the break-even chart rather than have it in a table format because it's just a better representation of what the data is actually here. And also, it's good to have like sort of an executive summary that includes all the information. So it's the developing start date, the capacity factor, the energy generated every year, and the average EBITDA of the project, the levelized cost of energy, and like a small table of the sources of capital and the uses of capital. And this number needs to be equal to this number. So 75% of my capital is coming from a project finance loan, and which the value is around 300 million, and I'm putting in equity around 100 million. And where am I using it is basically mostly in CAPEX, so 86% in CAPEX, capital expenditure, that is construction cost and other costs, and the other goes into acquisition of the land and interest accrued during construction and the other advisory fee. So I took the assumption that the advisory fee is 2% of the capital raise. Right here, I just source the same information from the sensitivity I did for the DSCR here, but I put it in a more visually appealing format, and I say that this is the given that you gave me, that the required DSCR is 1.8. So by doing that, I'm showing that the team that for the assessment, obviously, is that only at 93% of the loan is amortized. So to get to a 100% amortization within the operating period, I need a 1.7 DSCR. So this is the tricky part of this project is actually it is not recommended to go for this project if you have a 1.8 DSCR because you can't negotiate it with the banks basically. Um, if you are, then that is great, but you need to assume a refi by the end of the operating period. So you would need to assume another PPA, power purchase agreement. And so I represented also the capacity factor here. And what I did is basically I'm showing that at a 34% capacity factor, my project IRR is 6%, and this is the base case. So if that changes, obviously my IRR is going to go down, and if that goes up, my IRR is going to go up for both cases. This is my tax credit for the period because I have a tax carry forward around 30%. And so and the major and it's good to represent how the structure of the levelized cost of energy is. So you have the O&M, the CAPEX, and you have the loan. So the majority of where the cost is coming from is from the construction of the project, followed by the operations of the project, and followed by the loan payment. But however, if you add this up, it is 33.25, which is here, which is good amount compared to what other technology have reached in record. And so yeah, it's good to represent it this way. It shows you did an extra effort. And right here, what I represented is I wanted to show the leverage effect. So you can see here when I start paying the loan to zero, directly I start getting a levered effect for my equity. And this starts after the 36th year. Um, it's important to include your commentary because this is the given. It says to include around 10 bullet points of analysis and conclusion. Please reach out to me if you have any questions. I'll be happy to answer your questions. It is made so that it is a simple model and easy to understand. It is not made so to complicate matters for you. The formulas are very easy to understand. Nothing of around 2 lines of a formula. And maybe you may have a little bit of difficulty understanding how I capitalize my tax credit and how I calculated it. But don't hesitate to reach out if you have any questions. And I hope I help you out with this journey. And I wish you all the best in your exams.